In this video, traders are going to look at trading a breakout from the Double Doji. Stay tuned. Hey traders, warm welcome to you. Alright, so what is a doji? What is a double doji? What is the double doji breakout strategy? First of all, what is a doji? So a doji looks pretty much like this, or it does look like this, on a candlestick formation. We've got the high, we've got the low, and the open and the close are the same. So in other words, what's happened intraday, which is what the key thing about understanding candlestick pattern, guys, is to know what's happened in that candlestick. So assume it's a daily chart. What's happened intraday? Let's have a look. So here's our intraday chart. Bang, bang. Okay, we've opened here. We've pushed up a little bit, we've come down, we've pushed down a little bit, and we've closed there, giving us that doji pattern. In other words, we've pushed up, haven't really found any more buyers, pushed down, haven't really found any more sellers, and come back to exactly where we were. Now, these don't tend to be big extensions, right? They tend to be very slight pushes up, very slight pushing down, never too far away from the volume weighted average price, just back and forth. And we get what's called a doji. So a double doji, pretty self-explanatory, it's just two dojis in a row. So what does that actually mean from a perspective of chart participants and all that other good stuff? Well, it basically means that there's indecision, right? If you can imagine that's happening on a daily chart, or an intraday chart, sorry, that's a daily candle, then no one's really in control, right? So thinking of supply and demand, thinking about what's happening from perspective of supply and the demand, we've had push up, push down, we're back into equilibrium again. So no one's really in control, so no real edge for us. Unlike other conditions where we get a big extreme, we've got a big edge. So what do we do with that? So what we can do is we can make the assumption that actually what people are doing is waiting. They're saying, okay, buyers aren't really going to get too aggressive yet, sellers aren't going to get too aggressive yet, but if we break out, maybe things are going to happen. So what we can do as traders is we can start to frame this trade. We can start to say, right, well, there's the high, there's the low, and I recognize I've drawn these equal. They're not always going to be equal. There might be something more like, there's your doji here. You might get one that's, slightly smaller, for example. But again, you're still bracketing the 2-day doji high and the 2-day doji low, and you're saying, right, well, I'm going to trade a breakout of that. So if you're looking at a kind of a daily chart, an intraday chart, hopefully you can just about see that on there. I made it a bit small, didn't plan to do this, but let's say we've got this now. Okay, then we do the same thing. We draw on our 2-day chart and say there's the high, there's the low. So that would look like that, but that would look like that on our 2-day chart. It's a 50-minute, 5-minute, whatever. And what we're going to do is when we break one way or the other, we're going to follow that break. Now the assumption, of course, is that this is paused for a reason, and it's better if the conditions are a little bit more active. So I've got a couple of examples here for you. We've got this one where we've got a nice uptrend, a good push up. That's probably one of those would be red, wouldn't it, in reality, or orange. Got them here. Good push up, and we've got this double doji at highs. Now the obvious kind of breakout for this is to wait until it breaks that high, jump on it again for a further move. This is almost like a consolidation and a flag, and it actually is, because when you look at it from an intraday chart, what does it look like? It looks like a 2-day flag, but it just looks like a doji and a nothing going on a daily chart. So actually, it's not bad. Now, it actually as well, don't forget, means that it's quite a high consolidation. So from a buyer's perspective, it's good because sellers haven't managed to push it down and push back into this trend here. We're almost accepting that level there without much going on. And generally speaking as well, volume, guys, volume might pick up and then it will die down on that doji. And so the next day, we're going to have a buy here, and we're going to go long as it breaks. Just rubbed it off with my little finger. You're going to go along as it breaks the top of that doji. That's the key to this. And same with this one, except this is slightly different because here perhaps it's a little bit less interesting. It's down a little bit, up a little bit, not quite as aggressive perhaps as that. And so we've got what we're going to do here. Same thing, but maybe we can take it in two directions. And so we could say, right, there's the high, there's the low. And actually it could be a trend reversal, right? It could have pushed back up. This could be a low. It gives you an opportunity to say, right, people are taking a breath, people are relaxing, people are stopping. The next burst of volume, the next burst of momentum is something I want to jump on and get on board, which is why it's quite nice to see them, because you get 2 days of that and then bang, you're on it for the next day. And very often, because the volume has died down like this, you get a spike back up as it pushes in that direction. Everyone piles back on again, whichever way it may be, and it's all good. Now, one thing to add, guys, as well, is you might get a fake out, especially, and you know, I want to emphasize again that it matters where price position is. You know, it does matter. If it's in the middle of the range and you're getting dojis, not that exciting, right? If this is just in a range bound condition for ages, maybe you don't want to take it, or if you do, you don't want to be looking for home runs on it. But if it's in good conditions and a good environment, then it can be the precursor for volatility expansion, which is always good from a trader's perspective. So one thing you can do as well is you can look for a fake out from the second day. So if you're getting a little bit of a fake out to the downside, especially if you're in this type of thing, so the market then pushes under here, everyone's getting all excited thinking, oh, it's broke the prior day's low, but you're like, okay, well, I'm looking for the 2-day low here, not the 1-day low. And then it starts to reverse and starts to push back up on this sort of chart. That might be an even more powerful buy for you because it's done some work to the downside and failed, and then pushed back up intraday. So when it's kind of, you start to use then some intraday price action techniques with a broader kind of daily chart as well. All right, guys, that is the double doji breakout strategy. Take care. See you next one. Bye-bye.